Good morning, everyone, and thank you very much for joining this morning. This is our new morning webinar called the Morning Market Review. My name is Russell Shaw, Senior Market Specialist at FXCM. My email address is archer@fxcm.com, and today is Monday, it's the 28th of Feb 2022. Just going to bring up our high-risk investment warning. I'll keep this on screen for a few moments. Right, let's just bring up our market commentaries disclaimer. Hey Howard, morning to you. Nice to have you in the webinar. And let me just bring up the references. So that shouldn't FXCM Markets 2.0. That I need to change. That should read Cnbc.com. Yeah, I think I wrote that in a rush. But we're going to look at Markets 2.0 and we'll look at Cnbc.com. I'm just going to read the morning notes to you. Let's just bring up the weekly chart for the DAX. All right, so before we get into the chart analysis, let's just take a look at the CNBC news headlines here, and the headline reads European market set to plummet at the open as new sanctions are imposed on Russia. And it reads as follows: European stocks are expected to open sharply lower on Monday as global markets track developments in the Russia-Ukraine crisis. The Russian advance into Ukraine has continued throughout the weekend. Russian military vehicles entered Ukraine's second largest city, Kharkiv, with reports of fighting take place and residents being warned to stay in shelters. More sanctions have been imposed on Russia for its invasion of Ukraine, with the US, Europe, and Canada agreeing Saturday to remove key Russian banks from the interbank messaging system SWIFT. The UK and EU have also closed their airspace to Russian aircraft. Russian President Vladimir Putin put his country's nuclear deterrence forces on high alert Sunday amid a growing global backlash against the invasion. Ukraine's defense ministry said representatives for Ukraine and Russia have agreed to meet on the Ukraine-Belarus border with no preconditions. US stock futures have moved lower in overnight trading on Sunday as investors grew concerned about the economic ramifications of the Russia-Ukraine crisis. Meanwhile, shares in Asia Pacific were mixed on Monday. Oil futures were up more than 5%, and the Russian ruble dived around 29% against the dollar on Monday morning as shares assessed the impact of sanctions on Russia. Earnings from AFSL, Signify, and GSK on Monday, with data releases including preliminary inflation data from Spain and Portugal for February. All right. So that's the morning note. There's a couple of other headlines that I just pulled up. So we've spoken about oil. We'll take a look at the oil chart. The Russian ruble plunging nearly 30%. Okay, I think we'll pull that up. But this report here is of interest. Russia central bank hikes interest rates to 20%. From 9.5 to bolster the ruble. So Russian central bank has nearly doubled the country's key interest rate from 9.5% to 20% as its currency, the ruble, hit a record low against the dollar on the back of a slew of new sanctions and penalties imposed on Russia by Europe and the US for its invasion of Ukraine. The central bank said is designed to offset increased risk of ruble depreciation and inflation. It follows from central bank's order to halt foreigners' bids to sell Russian securities in an effort to contain the market fallout. All right, so we will just read it as far as that, but 20%, so jumping from 9.5 to 20%, that's clearly a massive increase in rates. That will have ramifications. And the removal of Russian banks, or certain Russian banks off of SWIFT, is massive. It will impact capital flows, international capital flows. All right. And as just right, the Russian central bank has also been blocked. Okay, so let's take a look, perhaps, see if I can bring in the ruble here, and then we'll take a look at the DAX. My system's on a massive slow this morning, begging your pardon. All right, let me just bring up US dollar ruble. We'll do it on trading view, not very much like it. All right. Taking a look at the trading view screen. So I should have put this on the reference page as well. Let's take a look at the ruble. I'll just use this one, the 6er. All right, so you can see the jump here in the ruble. That's a big jump, isn't it? This is the daily. Let's take a look at the weekly. Okay, so that's what the central bank is responding to. Okay, so let's go now to our charts here. We'll start with the DAX. And what we need to focus on here is the stochastic, and I'll tell you why I think that's the big deal. It's very important to try and get a gauge on the sentiment that's currently sort of running the market, and the stochastic is a terrific indicator in terms of is a terrific indicator in terms of market sentiment. If we just go back to here's the beginning of the pandemic period, and you can see that as soon as the market starts flooding with liquidity, the sentiment becomes incredibly positive because the money has to find a home. And so between these two blue verticals, take a look at where the stochastic is. And if we have a reading above 80, well, the sentiment there is extremely bullish. Okay, and you can see what happened is that we got a really good capital appreciation, right? And what we need to do here is try and assess the sentiment, and looking at the price chart certainly helps. If it's going down, there's a negative sentiment. But the longer that the stochastic remains suppressed, well, that is a derived off of price, and as long as it stays under 20, well, then the greater the likelihood of a enduring bear market. And why I think the stochastic is a a really good indicator to keep an eye on, is because when you have zigs and zags in the market, and we've got a sort of a benchmark or a threshold level of 80 or 20, we can deal with the ebbs or flows of the market, not get caught up by sucker rallies. So we just want to keep an eye on the stochastic. If it goes below 20, if it goes below 20 and holds, that's going to apply a pressure on the DAX. You can already see that the EMAs have started to show what we call angle and separation. Okay, so you can see that we're starting to get angled downwards and they're starting to separate. Well, that's momentum right there. That's a reflection of momentum. The moving averages, okay, fall under a class of indicators called trend following indicators. Trend following indicators, as the name implies, work in trends. They don't work in consolidations. Here's a consolidation. Clearly they don't work because we've got just tons of false signals here, what we call whipsaws. But the longer they show angle and separation, okay, without those whipsaws, there's the trend. Again, combining that with the stochastic, we get a really good reading of what's going on the way up from the flood of liquidity. Now we've got this geopolitical situation on our hands, and we've got this angle of separation of the EMA starting to point down, and the stochastic heading towards 20. So as long as those conditions hold, two conditions, angle and separation, and lower quintile, that's the real characteristics of a bear market. We need to get the stochastic, or we need to see the stochastic moving towards 80. That would suggest to me that portfolio managers are buying stocks that they see at good value. Now, the interesting candlestick is, of course, last week's weekly candle. This is actually a fairly bullish candle, isn't it? In other words, there was this big sell down until the low. There's a big sell down and towards the low. At the low, the bears lose control. Once the bears lose control, the bulls take price and we close up. So a fairly sort of good ending to last week. Now, take a look at last week's close, which is here, compared to this week's open. So although we've got this blue candle here, this is a huge gap down. Can everybody see that? I'll change it to the daily. Should sit better on the daily. But you'll see here's Friday's close. Here's Monday's open. Sorry, here's Monday's open at the bottom here. It's a blue candle, my mistake. And there's just this big drop down here. Now, let's sit on the. You should be able to sit better on the daily. Let's just go here. Okay, here is Friday's close. Okay, here is Monday's open. Okay, here's the gap. See that? All right, so that's a huge gap. That's a huge gap. So the question is, why is there such a huge gap? And the answer to that, we all know, is because there's a massive risk-off sentiment that has market participants in that they are no longer prepared to trade at 14.6, right? We're much more comfortable to trade at 14.1, 14.2. So that's why there's this gap down. All right. Now, let's just talk a little bit more about gaps. There's different types of gaps. Okay. There's a lot of questions coming in here. Comment on trading view. This is from Anna. The ruble's about to do a lira. And well, you could see there's that massive move up, wasn't there, Anna? Howard's asking, how come some currencies have appreciated with the risk off, like Japanese yen? That's a very good question. We'll come to that. Peter saying that he's trading Aussie and Kiwi crosses, maybe safer with tight stops. We can take a look there. I think that that's another good point. And then Chris asking, what is the settings on Stochastic? All right, so let's just answer those questions. Then I want to come back to gaps. So the first thing is, what's the settings on the? So this is a slow stochastic, Chris, and I've just got 1555, and I'm not showing the percent D. I don't see the point of the percent D in this type of analysis. It's, for me, the percent D becomes important on the lower time frames, but just to get a sentiment read, I've taken it out. But we've got 1555. What you're actually looking at here is 15.5. Without the percent D, we don't have the. Anyways, all right. So Pete's. All right. So Peter's question. It's not his question. It's actually a statement, and I don't have the answer for it, but I'll tell you what comes to my mind. So he says he's looking at sort of Aussie Kiwi crosses away from Europe. Are these safer? And I'll just tell you something interesting about bull bear markets and correlations. So what's interesting about these things is that when you're building a portfolio, ideally, you want to have uncorrelated instruments within the portfolio, because it offers the benefit of diversification. When you're building a portfolio, the risk manager, or the portfolio manager, I beg your pardon, look at risk over return. So the risk is far more important in terms of management in the return. And then so what a risk manager does is he looks at the correlation coefficients of what he's looking to put into a portfolio. And the closer you can get to zero, okay, the larger the diversification benefit. In other words, let's just say you're holding two instruments, and one instrument is, and let's say they both got zero correlation, and let's say one is going down, while the other one could be doing anything. It's not correlated with the fact that this instrument's going down. In other words, your risk, it may be going up, but maybe going, but the point is it's uncorrelated. It's no use having a portfolio where you've got correlations that are +1, because that means you are exposing yourself to huge risk. So if you've got two instruments and they are both +1, they're perfectly correlated, it means they're going to move together, right? But it's no use having a -1, because they're going to just offset each other, so that your net return is going to be zero. You've actually effectively, got like a perfectly hedged zero risk portfolio. With zero risk, there's no chance of reward at -1. So you want to get as close to zero as possible. The interesting thing, Peter, is that in bear markets, the correlations tend to +1. So it doesn't really matter which part of the market you are operating in. Instruments correlations in real bear markets tend to correlate together. They all fall together. So in the global financial crisis, instruments tended to do this. They just tended, even if they were not that well correlated before. So to answer your question, it may be safer, but don't bank on it, okay? Because I'm not sure exactly, and I don't think anybody is, just quite where the geopolitics are going to be taking us. Howard's question was, how comes the Japanese yen moving up? And that's because it is a safe haven currency. Let me just, let's go through to US dollar Japanese yen just to see what's happening here. But actually, US dollar Japanese yen's moving up. Let's go through to our Japanese yen basket. it's holding its own, I guess. It's just moving sideways. If I'm understanding the question correctly, Howard, why is the question, why is the Japanese yen not weakening? I think that's the question. The Japanese yen is a safe haven. The reason it's regarded as a safe haven is because most of Japan's debt is actually held by its citizens, which is viewed as a lot more, a lot safer than saying foreigners holding a country's debt, which is with most countries. And the other reason for that is because there's no interest in Japan. Not that there's much interest anywhere else, although we are in this rate hiking environment and rates are going to be moving, they've moved swiftly off the zero bound. But Japan's had low interest rates for decades, so investment in Japan tends to go offshore in search for yield. But as soon as there is some sort of risk-off event that scares the portfolio managers, they'll bring the currency back into Japan. So as soon as there's a risk-off event, there's an immediate buying of Japanese yen because it comes back into Japan. So it's kind of a thermometer, so to speak, of risk. Another safe haven currency would be Swiss franc. I don't have that here. I don't trade the Swiss franc, but it's generally regarded as safe because Switzerland is a neutral country, and it used to be backed by gold. It's not backed by gold anymore, but I think it was the very last currency to be backed by gold. And we'll just take a look at it. And of course, what is used for this? We'll see here. Let's take Japanese basket out. Let's take Nasdaq out. All right, let's pick back this guy. Let's see what's happening on the US dollar Swissy front. All right, so it's also fairly constant. It's also seen as a safe haven. Let me just see if there's any other questions. So Chris, got to, Peter, got to. Yeah, then Anna's just was a comment as well. Anna's just saying the ruble may be about to do a lira, which it does seem that is the case. Let's just go back to the, if I've missed anything, just let me know, but I think I've got everything there. Just want to go back to the DAX. I want to talk about these gaps. We have mentioned them before. So this is a potentially sort of dangerous. Again, the thing with gaps is sometimes they close, sometimes they don't, and they close just as they close just enough times to say, well, gaps tend to close, right? But I think the way that we should keep an eye on this is under the gold would be a safe haven, absolutely. Gold would definitely be a safe haven, yeah. There is something called a breakaway gap. Okay, breakaway gap. There is something called a runaway gap. And I think if you just go through to, say, stockcharts.com and look in the education section on gaps, you will see that they'll have this. So there's breakaway gaps, there's runaway gaps, and breakaway gaps, runaway gaps. There's something called I think exhaustion gaps. Okay, so the way that these basically, I think I've spelled this right. No, I haven't. I can't remember if there's an H or not. I think that's right. The exhaustion. Excuse the spelling. It doesn't look right. No, looked right with the H, didn't it? All right. So yeah, stockcharts.com. Yeah. So what the question is? Well, what is this? What is this? So if it's a breakaway gap, well, then we're in a bear market. Then it's breaking away then it's breaking away from the from this consolidation, and that's very dangerous. Then we've got the angle and separation. And then we've got stochastic heading towards the lower quintile, and we've got this massive breakaway gap, meaning that the sentiment is really fearful. I mean, the market participants have there's no ways that we're going to be trading at 46 anymore. I mean, price is coming down. So if this is a breakaway gap, that's dangerous. So breakaway gaps tend to start at trends. Runaway gaps are in the middle of trends, which is if this is classified as a runaway gap, I don't think it would be, because we don't see that. I don't think the trend is full enough. I don't think it's evolved enough, I beg your pardon. But if it's a runaway gap, it's also a continuation. That's no good. It means it's running in that downwards direction. The most bullish situation here would be if this is an exhaustion gap. In other words, it's just the last sort of weak holders who are they the guys that gapped down. Now they're all out of the market, and now there's some sort of accumulation that's going to go on. So if it's an exhaustion gap, then the gap will close. If it's a runaway gap, markets are in trouble. If it's a breakaway gap, markets are in trouble. I wouldn't classify this as a runaway gap. I don't think a runaway gap takes place in the middle of a trend. This is either a breakaway gap or an exhaustion gap, right? Either the weak holders are getting cleaned out, or there is strong holders holding short positions down or exiting long positions. So that's, unfortunately, we'll have to wait and see. But the idea here is we are certainly needing to keep an eye on this stochastic. That stochastic dips below 20 with an angle and separation. Then there's probably something. So we've got to be very careful here. Now, if we go through to our zone analysis here. This is actually a really scary looking chart, because what's happening here is, where's the scary part for me, is over here. That's the scary part for me. So it's sort of an odd sort of thing to say, considering so much is happening here. But it's really this over here is what we've got to keep an eye on, because what happens is, with trends and Bollinger Bands, is there's steps to how they evolve. So if we go to the last trend, which is back here, there's a breakaway, not a breakaway, there's a sort of a bubble. They pull away from each other. So the upper Bollinger pushes north, the lower Bollinger pushes south. They move, and then the trend here, so we're in zone 1, so that this is an uptrend, okay, that lasts a fair amount of time, but the bottom Bollinger plays catch up, because remember, it pulls away at first, and then as the price starts moving up, it starts pulling the lower Bollinger with it. What I'm trying to say is the direction turns. It turns from south to north. The bottom one, the direction change there is confirmation of trend. It's confirmation of trend, and of course, that's the scary part over here. Okay, it's turning down. Okay, that Bollinger starting to follow price down. So we've got a lot happening that we need to just keep an eye on. Sorry, I'm going to go do this. We've got angle and separation in moving averages. We've got potential stochastic moving into lower quintile. We've got is this a breakaway gap or an exhaustion gap? We don't know yet, but we've got the Bollingers starting to turn down. So this is all a big bearish picture that's starting to build. The idea here is we don't want to get stuck in any sort of forecasts, predictions. What we want to do is we want to follow price action. Price action is weak. It's weak until it's showing signs of support. Well, we just don't have that sign of support on this Monday morning. It may be that the gap closes, okay, and then we can say, all right, maybe this is an exhaustion gap. Maybe all the weak holders dump their stuff, dump their stock, and it was picked up by the pros because the pros reckon this is now a good buying opportunity. So there was just exhaustion here by the weak holders, and that may be a possibility. If that is the case, we're not going to predict it. We're going to watch for the stochastic to turn up. We're going to watch for the angle and separation to start showing actual contraction instead of diverging. Okay, we want to see the EMAs converging on one another. Okay, converging would be showing support, moving back towards 80. That will be showing signs of support. This gap closing, okay, that would be a sign of support. The movement of the price out of zone 3 into zone 2, that would be a sign of support. None of those things have happened yet. Those are things that we're going to be watching for. If they don't materialize, we're moving down. Okay, then we're moving down. So then we go through to our hourly chart here, and here's the gap. Okay, so here's the gap. I don't know if you guys can hear that bird in the background. We've got these crazy birds here in South Africa. All right. All right, so you can see we've got this gap here. All right, so the question is it going to get closed? If it gets closed, maybe we've got this exhaustion gap going on. Maybe we've got this exhaustion gap going on. Okay, but all right, keep an eye on this S1 level. Okay, we want to keep an eye on this S1 level. So we've got gap acting as resistance. I'm going to talk about that in a moment. Gap acting as resistance. As we hit the S1 level, all right, there's no oversold condition. Okay, so there's, now keep an eye. This is where, remember I said I don't like looking at the %D on the higher time frame. On the lower time frame, I think it's vital. So if we get across that down into the 20 area, if the S1 level holds, then we could get this movement down. We'll see at the end of this hour whether this has been an exhaustion or a breakaway. Now, the reason that this may be a tough level, okay, again, it all depends if it's that exhaustion or breakaway gap. All right, the idea here is, let's just say that you decided, sorry, I'm on the wrong chart. So you can see, let's go back to last week's candle. Let's go back to last week's candle, and you can see that in last week's candle, the bears lose control at the low. Okay, the bears lose control at the low. Bulls push price up, and they do a really good job of closing well off of the low. So this is a buying tail. This is actually a fairly bullish candle. Now, imagine that on Friday, just before market closed, you take a look at this chart and you think, well, this is looking actually pretty good. I think that the bulls have done a great job here. I'm going to buy, let's just say you buy a DAX ETF, just so or you buy the CFD here, right? Now you're holding it, and you wake up on Monday morning and you come and you take a look and you see this huge gap and it's against you. All right, so now you're holding a huge loss because you went long over here. It's gapped down on the open and holding this huge loss, and now you are thinking, well, if I can just get out, at break even, okay, in other words, you're looking to sell somewhere here, because on Friday, this is where we close. On Monday, this is where we open. If I can just sell as close to break even as possible, just to minimize my loss. Now, you're not the only one that's thinking that. And when I say you, I'm using it in a hypothetical sense, right? Everybody who's holding a long that they bought over here is wishing for the same thing. Okay, so now these guys want to get out as close to break even as possible. Now, if this is an exhaustion gap, it's going to act as resistance as well. Okay, because there's just going to be selling pressure because guys want to get out as close to break even as possible. So you've got S1, you've got a gap down acting as resistance. You've got the stochastic pretty close to 20. If this crosses, it goes back down to 20, and this S1 level holds. I think we're going down. And it's not only that, we've got this very weak looking stochastic on the weekly. We've got a very ominous looking angle and separation on the moving averages. So it really comes down to this: is it breakaway or exhaustion? I don't know. I don't have the answer for that, but you know, you tend to not forecast. You tend to react to what's happening here. And it looks like that we may have this down, we may have this breakaway. Keep an eye on this gap. Does it close? Or if it closes, that would be the first bullish step in a progression. Okay. We had a trend line last week. So I think what you're referring to, Pete, is on the weekly. Is that right? Let me just use this one. I think this is what you were referring to. Is this what you're referring to? So we'll keep this in. This is your 1482. Is that right? Is that where we had resistance? This is our resistance area. Let's make this a deeper color. And we'll put this there. And then, of course, let's not forget we are in a bear trend. We've got a lower peak, lower trough. Okay. If we go up here and it hits this trend line and it comes back down like that, then it's a series of lower peaks, lower troughs. That's tremendously dangerous. Okay, that's why I'm stressing that we keep an eye on the stochastic. The sooner it can get above 50 and head towards the 80 area, the more bullish we're going to be. Then we can be looking at sort of dips in downtrends. We don't have that luxury at the moment. What we're doing is we're watching very carefully to see if the market participants have the wherewithal to really take us above this gap. And at the moment, they're struggling. You can see at the moment they're struggling. Anna writing here, she's actually got two interesting comments. The first one, I don't think I can answer it because I just don't know. She says, would trading the ruble be a risky trade? I think that would be a hugely risky trade, Anna, because the potential for Russian central bank interference there is massive. They've already tried to, they've already doubled the interest rate. That is a high risk trade. So that's my thoughts. I hope that answers the question. In fact, if you take a look at, you made the analysis against the Turkish lira. The Turkish central bank interfered constantly in trying to stem the tide. Okay. So I mean, imagine you kind of shorted the Turkish lira here. Shorting the Turkish lira means going northeast. That means US dollar appreciating. So you can see there was huge risk here. I would suggest there's similar risk. Germany is affected more than many other countries by the sanctions. Yes, I think that is true. Let's just bring up Brent. I think that is true. the energy situation, which we're talking about oil, we're talking about natural gas, we're talking about coal. The exports from Russia into Germany are massive. We spoke about that last week. If I recall, it was 35% oil, 50% coal, 55% natural gas. Here is our Brent. Okay, so it's kind of struggling to keep above $100. So I would suggest, Anna, that whilst you're 100% correct, there's broader macroeconomic ramifications here. So if there is sanctions on commodity exports, that's going to hit Germany 100%, but it will be a global phenomenon as well. So we'll have to see how that pans out. I can't remember where I read the report or I heard it. Rolls-Royce gets 20% of its nickel from Russia, just as an example. 20% of its nickel from Russia. I mean, so we're talking macro, systemic in nature. So systemic is one thing happens and it's kind of like it's like COVID. It just jumps. It's systemic. It infects all different parts of the macro economy. So you can see that oil over here. What we'll do is we'll put a resistance here for the time being. Okay, and we'll see if this resistance level holds. The global geopolitics, I think, suggest the odds are against it holding, but we'll keep an eye on it. Let's just take a look at gold, and then I think we'll call it a morning. Oh, okay. I'm going to share that. Thank you very much. This is the gold chart, and you can see what have we got here. We've got angle and separation. And take a look where we are heading here. We're heading up. Howard asking for Bitcoin as well. Yeah, for sure. All right. I would suggest there is some sort of resistance here as well. I'll explain why I think that is subject to correction. And the best way for me to show you is to bring the dollar next to it. So the dollar's in this uptrend. This is actually over there. This is an old dollar chart, nevertheless. Okay, so we've got this. I think we've got this battle going on between gold and the US dollar in terms of where's the safety, right? So on the 16th of March, we're going to have a Reserve Bank announcement, a Federal Reserve Bank. I think 50 basis points is off the table. So I think we're looking at 25 basis points. I don't think the market could cope with such a heavy increase in interest at the moment. So I think that's why the dollar has started to reprice, so to speak. So there's resistance here for the dollar because, by and large, I was in the camp that we were going to get a 50 basis point. I don't think that's the case anymore. I think we're going to get 25. But I think the market generally was pricing in the potential for 50. Now that that's largely off the table, you can see the stochastic is starting to weaken for the US dollar, whereas the stochastic for gold is showing signs of strength. But why then is there this? Why is there then this resistance? So I think it comes down to the scenario of stagflation we spoke about on Friday. I think that if stagflation does manifest, ultimately capital will gravitate towards gold, and it seems that's probably what the market is seeing at the moment. But markets change on a dime. I think if that stagflationary effect starts to subside, and the way that we'll know that is if oil prices come down, then I actually think the Federal Reserve gets more room for more aggressive rate hikes. Then I think the US dollar starts moving up in a fairly steady ebb and flow. So we've got this kind of dynamic tension between stagflation, gold, no stagflation, dollar. That's the way I'm reading it at the moment. So gold rocketed when the Ukraine war began. Then it fell, went up again. All Greek and confusing. Pete saying welcome back to the 70s. Let's just end off. It's a very difficult market, Howard. I think the fact that you have said it so eloquently, is probably how everyone's feeling. And let's just take a look at Bitcoin, and then we will conclude. So I think this is the way I want to draw the parallel. I want to go to Germany, so the DAX. I want to go here, and I want to show you something very interesting of the Bitcoin and the. Last week we made, or at least I made the case that I don't think Bitcoin is a safe haven, and I would continue to maintain that until proven otherwise, right? I certainly don't think Bitcoin's a safe haven. I think, if anything, it's a highly risk-sensitive instrument. Okay, to the point that we actually did beta and standard deviations, I think, towards the end of last year, beginning, and they were off the chart. But this is a very similar chart. DAX to Bitcoin is very similar, and take a look at last week's Bitcoin, hammer. Take a look at last week's DAX, hammer. Okay, let's just see. So hammer, hammer. Take a look. Gap down. What happened? Gap down. Is it an exhaustion gap? Is it a breakaway gap? Okay, look where the stochastic is. I think that if we get some sort of recovery in risk, Bitcoin benefits. I think if we have a distinct risk-off sentiment, Bitcoin suffers. Bitcoin, for me, is certainly not acting like a safe haven. It's acting exactly like a risk asset at the moment, and we'll just have to see how that plays out. One more thing before we go. I haven't watched this, but this is from Anna. Thank you, Anna. She just said there is a YouTube video here, the economic effects of Russia's invasion. I'll just send that to everyone. I'll watch it myself. I haven't watched it, but I've just sent that. So thanks, Anna. Did everyone receive that? Did everyone receive that? I hope. All right. Okay, cool. All right, guys, let's wrap up here, and I'm going to chat to you guys tomorrow morning. All right, same time. Thank you very much. Please email me if you need to. Thanks, guys.